Look, I think the biggest for the last, let's take a 20-year perspective on this. Okay. So 20 years ago was when I would argue alternative credit solutions. So solutions that are designed to inform credit decisions beyond that of a standard classic FICO score started gaining some momentum. And I would argue for, let's say, 2002 through 2020, the biggest drivers were financial inclusion, right? The desire to lend to consumers who have little to no data footprint or subprime footprint, and that could be because of lenders feeling regulatory pressures. That I think often is the case. It could be lenders who are feeling pressure from investors from a value standpoint, right? People love to say that financial inclusion is a core tenet of their values within a financial institution, but are you taking real steps? That kind of pressure often led to increased adoption of alternative data. And then competitive pressures, right? It is to some degree an untapped area of potential growth. But of course, I said that 2 years ago, we started seeing a shift. And that shift was when two big factors started creating momentum in the use of alternative credit solutions on thick file consumers, which is unquestionably the fastest growing use case for these kinds of insights. Those two pressures are, again, we'll bring up competitive pressure, right? We're looking for areas to drive growth, particularly coming out of the pandemic. And so with more and more lenders in the game, how do you use alternative data to refine pricing and offer strategies to maximize your booking rate? Right along with that, you have all the innovations that have occurred in the financial technology space that have increasingly given consumers more of an ability to shop around for the best loan offers. And I'm saying loans, we could be talking about credit cards, we could be talking about car loans and mortgages. A consumer's ability to get multiple offers and compare those offers has never been stronger. And with that comes more of a pressure on lenders to optimize the offers they're putting forth to consumers. And that's where alternative data and that additional visibility it gives above and beyond traditional data alone is driving the ROIs we talked about earlier. I think what you start to see at many lenders is once they go through it used to be hard. Hopefully it's getting a little easier, work with their internal compliance and governance teams to get certain data sources approved. And they start realizing the benefits of these signals at account opening. The natural question is, where else can I plug these insights into in my customer lifecycle and drive real value, particularly again, now that some of the hurdles that made initial adoption time consuming have been addressed. Pre-screen, unquestionably, is the first place that lenders who are comfortable and getting sophisticated with alternative data are looking to use these insights next after account opening. And I think that's pretty obvious why that would be a case, right? We're still in a use case in pre-screen where the lender has very little information and very little firsthand exposure to a potential prospect or consumer. So they're really reliant on third-party data sources to get a read for the credit risk of those individuals. And so I would point that to be the next big area of the life cycle.